Sunil Subramaniam, good morning. Thank you for joining us. Are you doing, how are you dealing with this fall? I mean, I am telling people to do deep breathing and do pranayam and not panic.
Because you know what? We are the one AMC faced with a massive problem at this point in time. Because I just closed my NFO and got 485 crores from investors, 25,000 investors. And I'm really in a position where I have to put my money where my mouth is, in a normal situation, you can always say, I've already invested, my conviction buys are already there, so I'm just going to hang on there. But while that could be true for most of my portfolio, today I'm sitting on 500 crores of fresh money from investors, and I really have the thing on whether I start buying now or not. And it's a $1 million question, and I think the answer to that lies from our perspective in that since we are essentially looking at a 3 to 5 year period, it's a good time to buy. But I think given the very near-term outlook on the pandemic and how that's going to pan out, and India is still scratching the surface. We're still at about 60 odd cases. The government has acted very promptly, very smartly, shutting down all visa expiries, putting quarantine on all Indians who return from abroad. I think for a change, India is being very proactive on the health part, and that's the only thing which, just to keep fingers crossed, because if that comes through, if India restricts its cases to the hundreds and not to the thousands, right? I believe that this, if you look at it from a perspective of the three factors, right? Medical leading to economic correction, leading to stock market liquidity being pumped, right? That's the standard mantra. So from that point of view, India has kept the medical reasonably under control. We, thanks to the fact that our exports are not a great part of our GDP, are probably the least interconnected with the world, right? We are probably the most domestic driven economy in the world of the sizable countries today, right? So to that extent, while there will be disruption related supply side impact from China, while there will be some export oriented sectors seeing a slowdown because the world slowed down, by and large the Indian economy is insular and driven by domestic factors. Now I come to the third aspect of the economy leading to the markets. And today we are in a situation while liquidity is being pumped, interest rates are being cut, there is a risk-off situation. So money is going into gold, money is going into fixed income, coming last to equities, and then coming last to emerging market equities. So we are in a spot where there's plenty of money, but that money is not reaching out to the riskier part of the world, which is where India sits. Just to complete my story, so RBI, I believe, has no choice but to then cut rates, because if you don't cut rates, what happens is that you're going to face the currency as a big challenge between the US and India. So RBI has to cut rates purely from that perspective. Aiding an RBI rate cut in India is the fact that the only good news in this pandemic is the oil price crashing, which is good for a country that imports 85% of its oil. So the imported inflation, the core inflation is going to be less. At the same time, we all know that the monsoon has been good for the Rabi crop. So food inflation is probably going to ease. So from a domestic scenario with a rate cut and with a rural consumption likely to pick up from the bad levels that it was. Rural food inflation was actually negative some time back. So you're going to see a little bit of revival in rural demand. So to me, from that perspective, right, at the inflection point where the world feels that the worst is behind us in terms of the pandemic and the economic impact, when risk starts returning, India will be in a pole position to get the flows, because at that time they're going to look, hey, who's least impacted by this medically, economically, and there India will start out. My biggest worry is when that is going to happen, right? So that's the only inflection point for which I would wait before I commit my capital in a significant way. Otherwise, we are still buying in small lots because, as you know, we are a very stock picking oriented company with a large, small and mid cap portfolio. We know those companies which are very domestically linked, which have a good future, whose prices have corrected. So we are steadily accumulating those kind of stocks already. But to make a big play, I would just wait for this inflection. That when is the world actually going to say, hey, we have carried this oversold position too far. We have just, and what's happening here, it's not just a active fund manager thinking. What's happening is retail investors through ETFs are pulling out money from their ETFs. To some extent, this is algorithmic pullout. This is not active fund managers sitting there and saying, I'm taking money out. It's actually retail investors investing in ETFs across the world who are pulling money out from risk. Naturally, they are worried. So when that tilting happens, and that's the signal that I will clearly look and wait for, because if you look at it, I was just looking at the data, October 2008 crisis. Right? If you invested during that crisis, next 1 year was 63% return, next 3 years was 23% annualized returns. So clearly if I'm going to look at it from a 3-year perspective, I'm going to look at 20-25% kind of return from the broader market, whether it's large caps, mid caps or small caps. So I think that's the way I would describe my situation, Nikunj. I hope I've explained it in fair detail.
Right. Sunil, that's the other thing, because while equity inflows have actually improved in the month of Feb, the worry is that by the time March data comes out, it's going to be a very different picture. Do you sense with a market like this and the kind of panic that we are seeing right now, there will be a fair amount of redemption as well, and maybe even in SIP schemes?
Not really. At least the data up to yesterday, which I saw, at least at our counters, month on month, the inflows are about 3 to 4% higher. So I'm not yet seen any panic from retail investors. Our SIP flows are in fact steadily going up. So at least the first 10 days of March, we haven't seen that happen. Let's wait and see the next 2-3 weeks whether... See, one thing is there, right? I don't think... we have seen that through all of the trials and tribulations of the stock market, I don't think people have come to the stage where they're stopping or prematurely stopping their SIPs. I think that's probably the last thing to happen is the lump sum flows which could see a little bit of reaction. I don't expect people to actually short the SIPs, because what's happening on the other side is State Bank is cutting deposit rates. Your alternative investments, and as you know, the fixed income, the bottom has fallen out of the fixed income market with this 81 bond kind of a decision, on top of all these new credit events which have happened. So I don't think there's a competition to equities as a person wanting to put his surplus money, because he's not consuming today. He's not consuming, and small savings rates are also slated to head down. PF rates have also been cut marginally. So if you look at it from an alternative scenario, I would say that the challenge for equities on what they need to deliver, right, at 5.9% is what SBI's 1-year deposit rate is. You take the taxation impact of that, LTCG is still 10%. Equities returns 8%, you're going to be giving a handsome excess over your fixed deposits. So I would say that I'm not denying that there could be some panic reaction from HNIs, especially if you see last 6 months, small cap funds got a lot of flows. And obviously those HNIs who are trying to move in fast and capture the opportunity, they might move out because they made some money and so they will try to pull it out. But otherwise, I'm not seeing any broad-based panic on the equity inflows yet happening.
When 2008 crisis started, everyone thought that India will get decoupled. And it got decoupled for 3-4 months. Then came the tsunami. Why do you think this may not be a repeat of that? Right now, economy is dragging the markets down, but soon we will reach a level when markets will start dragging the economy down.
Yes, but Nikunj, if you look at it, what's the difference between then and now, right? One is the oil positive impact, okay? If you recollect, oil was then, 140 or something like that, right? One is that. The second, I would think, is that whatever happened, India is even more decoupled from the world than those days. I don't think the India's fortunes are so much linked. Third thing, Nikunj, is what I would say is that what is going to be the impact of this whole Wuhan-driven crisis is from a Western world, they will say, hey, let's not put all our bets on China. So I would increasingly expect people to diversify away from China. And India still, whatever you do, you can't wish away the population of young people we have and the low cost of per capita income vis-a-vis China. So there are certain fundamentals which are going for India, and how much ever you downgrade India's growth rate, I would argue that it will be 50 to 75% better than the average for the world, and at least 100% better than those of the advanced countries. So I think even a slowing down India would still be growing much faster than in advanced countries or an overall world average. So I think that's where I think the difference lies from the previous crisis to this one.
Sure. Sunil, great to have you on the show. Thanks as always for joining in with that perspective. It's a bad day. You've got all stocks. None of them are actually holding in the green.